India is on the front lines of the climate crisis. Rising temperatures threaten its people and its economy. India is a nation of farmers. They depend on predictable weather. Climate change makes this impossible. India is taking action. It has pledged to achieve net zero emissions by 2070. This is a bold goal. It requires a massive shift in energy, transportation, and industry. This shift needs funding. This is where climate finance comes in. Climate finance refers to money used to support climate action. It can come from various sources. These include governments, international organizations, and private investors. Climate finance is crucial for India. It needs to transition to a low-carbon economy. This transition will require trillions of dollars in investments. Green finance is a key part of the solution. It channels investments into sustainable projects. These projects reduce emissions. They also build resilience to climate impacts. Green bonds are an example of green finance. Green bonds are like regular bonds. Investors lend money for a set period. They receive interest payments. Green bonds are different. The money goes to environmentally friendly projects. These include renewable energy, energy efficiency, and clean transportation. Green bonds are appealing. They offer investors a way to align their money with their values. India's green bond market is growing rapidly. This is due to the increasing demand from investors. It also reflects the government's push for green finance. India's green bond market is still relatively small. It has huge potential for growth. The government is taking steps to accelerate this growth. It wants to make India a global hub for green finance. One key initiative is the issuance of sovereign green bonds. These are bonds issued by the government. They fund public sector green projects. The issuance of sovereign green bonds is a strong signal. It shows India's commitment to green finance. It also encourages private sector investment in green projects. Another important development is the growth of green bond funds. These funds pool money from multiple investors. They invest in a diversified portfolio of green bonds. This makes it easier for individuals to invest in green bonds. It also spreads the risk for investors. The Reserve Bank of India, or RBI, plays a crucial role in promoting green finance. It sets monetary policy and regulates the financial sector. The RBI has taken several steps to mainstream green finance. These include issuing guidelines for green bonds. It has also provided incentives for banks to lend for green projects. The RBI is encouraging banks to incorporate climate risk into their lending decisions. This means considering the potential impact of climate change on borrowers. For example, a factory in a flood-prone area might pose a higher risk. The RBI's efforts are helping to create an enabling environment for green finance in India. By providing clear guidance and incentives, the RBI is encouraging financial institutions to prioritize sustainability. Section 5. Bridging the investment gap. Despite these positive developments, India faces a significant climate finance gap. The Climate Policy Initiative estimates that India needs $2.5 trillion by 2030 to meet its climate goals. This is a huge amount of money. It requires mobilizing finance from all sources. Domestic resources alone are insufficient. India needs international climate finance. This includes funding from developed countries. It also means support from multilateral development banks. Global collaborations are essential to mobilize climate finance. The G20, for instance, plays a key role. It is a forum for the world's largest economies. The G20 has committed to mobilizing $100 billion per year by 2020 in climate finance for developing countries. However, this target has not been met. Section 6. Global collaboration for climate action. India is actively engaged in international climate negotiations. It is pushing for developed countries to fulfill their climate finance commitments. India is also advocating for more equitable access to climate finance. It wants to ensure that developing countries receive their fair share of funding. Beyond government funding, private sector investment is crucial. India is working to attract private investment in green sectors. This includes creating a favorable investment climate. It also means showcasing investment opportunities in areas like renewable energy and sustainable infrastructure. Section 7. Combating greenwashing, ensuring real impact. As the focus on climate action intensifies, the risk of greenwashing increases. Greenwashing is when companies or organizations make misleading claims about their environmental credentials. They might exaggerate their sustainability efforts. This is to attract investors or consumers. To address greenwashing, robust regulatory frameworks are essential. India needs strong standards and disclosure requirements for green finance products. Independent verification and certification can also help ensure the credibility of green investments. Section 8. A call for transparency and innovation. India's pursuit of net zero emissions by 2070 is a monumental undertaking. It requires a multi-pronged approach. This includes scaling up green finance, fostering global collaboration, and ensuring transparency and accountability. Transparency is essential for building trust in green finance. Investors need reliable information to make informed decisions. Robust data and reporting mechanisms are crucial. They track the flow of climate finance. They measure the impact of green investments. Innovation is equally important. India needs to develop new and creative financial instruments. Blended finance mechanisms, for example, can combine public and private funds. This helps to de-risk investments and attract more private capital. India's climate finance revolution is underway. By embracing transparency, innovation, and collaboration, India can achieve its net zero ambitions. It can pave the way for a more sustainable future for all.